One of the most popular alternatives to investing in mutual funds for an investor that wants a pre-diversified portfolio is an exchange-traded fund. What is an exchange-traded fund?
Sure, an exchange-traded fund or an ETF is an investment that's kind of like a mutual fund. The key difference, though, is that you can buy it and sell it throughout the day. So a mutual fund, effectively, you buy it once per day, but in an ETF, you can trade throughout the day if you wanted to.
So it's a pre-diversified security, and you can buy different types of ETFs that, say, invest in different types of styles, or they can be more diversified or less diversified, but you have that flexibility of being able to trade them throughout the day. But there's also different advantages to ETFs.
Right, so a key with most ETFs are passive investments. They track an index, and an important note there is that indexes 10 years ago were plain vanilla market cap weighted indexes. Well, today there's ETFs that track all these different types of things, and so when thinking about an ETF, largely they're passive investments, and like you said, you can get them in bonds and stocks and really kind of anything today. There's an ETF tracking some type of market. Now, one noted benefit of ETFs is possible tax benefits, and when thinking about ETFs, you should compare them to an indexed mutual fund. So don't compare an ETF to an active fund because it's kind of two different things. But an ETF can be potentially more tax efficient than an index mutual fund, but only by a tiny amount usually on average.
And why is it more tax efficient?
Well, it's the way that they actually do redemptions in the fund itself, and within a mutual fund, you are subject to the wills of the other investors in the fund. And so if the manager itself is making trades, you may not have traded at all the fund, but because the manager did, you have redemptions, you're going to pay taxes. With an ETF, it's a little different, and so they can be more tax efficient on average than mutual funds.
When a fund manager buys and sells funds and experiences a short-term or a long-term capital gain, and then the investor is responsible for paying that tax on the mutual fund, is that really the primary advantage of an ETF over a mutual fund? Is that short-term trading, the turnover element?
Well, yeah, I think that again, the key is what is your comparable. If you're comparing them to an index mutual fund, they're very similar. But an ETF is going to be much more efficient than an actively managed fund on average, as would an index mutual fund be.